Now let's take a look closer at supply and demand in Forex. A supply and demand based trading system is a relatively simple yet powerful way to trade the Forex market. It is considered one of the purest price action trading methodologies around. The rules of supply and demand analysis in Forex are quite simple. You should buy when price action approaches a demand level and bounces upwards. You expect the price to increase as a result of the aggregated buy orders in the demand zone. Therefore, you have the opportunity to ride an upcoming price swing. You should sell when the price reaches a supply level and bounces downwards. You assume that the price action will begin to trigger the aggregated sell orders in the area, which is likely to lead to a price drop. Thus, this creates an opportunity to ride a bearish move on the chart. You would put a stop loss order right below the demand area when you are going long in the market. Conversely, put your stop loss order right above the supply area. The most common approach is to hold your trades until the price action reaches the opposite level on the chart. So, if you are trading long a demand level, you should hold your trade until the price action reaches the next supply zone on the chart. Opposite to this, if you are trading short a supply level, then you should hold your trade until the price reaches the next demand level on the graph. Many times, however, there is no clear level to target, or it may be too far away. Often the price may not likely be able to reach an opposite level during its move. Therefore, I suggest you also use simple price action derived analysis when you determine your next exit point on the chart. To do this, you can use different price action clues such as trends, channels, or by analyzing swing tops and bottoms. Now let's apply the guidelines above into a supply and demand trading example. Firstly, we are going to take a closer look at a demand trade example. Now we have zoomed out a picture of the H1 US dollar index chart. At the bottom, you can clearly see at this bottom here, you can clearly see a marked demand zone. The demand zone is marked in gray and the supply zone is indicated with a magenta. See that the price action creates the demand zone after previous decrease. The price bounces several times from the demand zone and we would have had several opportunities to enter long trades. We assume that the demand zone will trigger new long orders, which will push the price upwards. The stop loss order should be placed below the demand zone as shown on the image. You can clearly see the bold red arrow. It indicates an area where I would expect you to put your stop loss. Notice as the price increases from the demand zone that it eventually reaches the nearest supply zone above. However, the price action breaks the level with high momentum, cluing us in that the level is not strong enough and that the dollar index might extend its bullish run. For this reason, the trade could be held on the assumption that the increase will continue. This is exactly what happens. The price initiates a new rally. On the way up, we see increasing tops and increasing bottoms, which clearly confirms that the dollar index is in a strong bullish trend. As you can see, price keeps on moving to the upside. We have higher highs, higher lows, higher highs, higher lows, signifying a strong bullish movement. Now let's take a look at a supply trade example. Right, here we've got the daily chart of USDJPY, which is showing us a trade example with a supply zone. You see, the two small blue arrows on the chart show the creation of the first two tops in the supply zone. We will look for short trades that interact with that level. The USDJPY could be sold after the bounce as shown with the first green arrow on the chart. The price starts decreasing afterwards. Soon after, a swing low is created and we see a sharp price move to the upside. This area subsequently forms a solid demand zone on the chart. The price returns to the supply zone for a retest afterwards. See that the USDJPY bounces sharply in the bearish direction. This creates another short opportunity on the chart. The pair could be sold again after the bounce from the level. After the price decreases, it reaches the magenta demand level on the chart, creating another bounce. The second short trade could be closed when you recognize the bounce from the gray demand zone. The price returns to the supply zone and bounces again downwards. This leads to a new price decrease. However, this time the price action engulfs the demand zone, meaning the bearish force is stronger than usual. In this case, you would have had a sufficient reason to hold the trade on the assumption that the selling pressure has taken over and the pair is entering a bearish trend, and we can see price plummeted for almost 9 days. So as you can see from the chart, guys, we've got our supply area in the magenta color. Price dropped here, then it rallied upwards, it tested the demand, it dropped again, and it created a strong demand area here where price came back, bounces up back to the supply zone area again, dropped to the demand level, and it tested the supply area, but this time price plummeted and engulfed that short-term demand level that was created. Then price went all the way down. So you can see the green arrows, these 3 green arrows, they all indicate levels you would have taken short trades from. If you are trading USDJPY, these are the levels that you would have looked for short entries into the market, and you can clearly see they all resulted into nice movement to the downside. Now, to conclude the section, let's point out the most important things to take from this section. The rule of supply and demand states that price increases when demand is higher and supply is lower. Price decreases when supply is higher and demand is lower. The supply and demand rule applied in Forex trading means price increases when there is a high buying pressure. That's from the demand area. And price decreases when there is a high selling pressure. That's from a supply level. Supply and demand zones in Forex are turning points where the price action is likely to reverse. These levels can be visually expressed on the Forex chart. A demand level is located below the price action, and it is expected to create buying pressure due to pending or unfulfilled orders in that area. Conversely, a supply level is located above the price action, and it is expected to create selling pressure due to pending or unfulfilled orders in that area. And to draw a supply and demand zone on the chart, you should identify an area where price action has created a swing level with a sharp price move. Take note, guys, a sharp price move. It's very important that the move has to be sharp and quickly away from a level. Stretch a rectangle 2 from the left to the right to mark the area. To trade supply and demand methodology in Forex, you should buy when prices bounces upwards from a demand area, and you place your stop loss below the demand zone. You should sell when price bounces downwards from a supply area, and you should always place your stop loss above the supply zone. At a minimum request, you should always try to hold your trade until at least price action reaches an opposite level on the chart, or use price action to manage your trade. Don't always get into a trade and you get 5-10 pips, then you close the trade. Look at what the higher time frame is telling you. Look at the next demand level. If you are in a long trade, look at the next supply level for your targets. It's not always a case of open and close, open and close. Try to follow the rules. If you are trading long, then your target should be the next supply area. If you are trading short, then your target should be the next strong demand level. I hope you guys have learned something from this section, and let's carry on into the next